Welcome to One More Round with Josh Norris. Today I'm really excited because I have my first co-host, Vince. And if you don't remember Vince Licata from a couple episodes ago, I mean, he was awesome. He has a staffing company local, and he's brought a friend of his that he knows, John, with us today, and we're super excited. John is a certified financial planner, and he's going to share with us some knowledge that he has about the industry and hope, talk about what's going on these days.
Josh.
Yeah, pleasure to have you. Yeah. So,
Where would you like to start?
well, let's start with, how do you guys know each other? How did you meet at least?
Actually, that's an interesting story. We were standing in a rental place, and I had one of my financial caps on, and years ago he had some investments with the firm that I was representing on the hat. It's one of those free hats that I get, and we just hit it off from there.
Okay.
Just kind of had a
Became
reason to
friends?
talk
It
to
was
each other.
it was U-Haul.
Yeah, was it U-Haul? Yeah,
It was
that's right.
U-Haul, and I was helping my daughter move up to Flagstaff,
Wow.
and I won't mention the name of the
I
company.
can't
but
remember why I was there, but yeah.
Yeah, I was trying to find this company that I used in Florida, and I couldn't find them anywhere. And all of a sudden,
We were a branch of them then.
this guy comes
Yeah,
walking by
yeah.
me, and U-Haul pushed me out of the way to get in front of the line, and he had a LPL shirt on, and I said, hey, and anyway, just
Yeah.
hit it off.
Cool. Awesome. And how did you get into the financial advising world?
Well, it all started back in 1987. I had the opportunity to join a mutual fund company, and they actually spent the money to train and get me licensed in the securities business. And that was back in the late 80s. I worked for that company for about 2 years, and then I worked for a local municipal bond firm for about 7 years. And we did a lot of different things with municipalities and municipal bond offerings to retail clients back in those days. And then in 1995, I left that firm and I created my own company. So I founded in 1996 my current organization, Netvest Financial LLC. So I founded it in 1996. Got a great firm since then. Still functioning. We're one of the larger financial planning firms or financial advisory firms in the Valley, and got a great team of about 14 people. We're located over in Scottsdale, and what we do is we manage people's money. And our claim to fame through the years has been really focused on estate planning and asset preservation and asset management. So that's where it gets into the weeds, because out of all the things that are out there to offer to people to invest their money, or all the things that you hear out there that you can invest your money into, where does one start? How does one think about, going into the stock market or the fixed income market, or should I be in annuities, or should I be in Bitcoin, or what should I be in, how should I be in it? All those things need to be learned. And the only way that you can learn that is how I look at it, is $1 at a time. If back in 1987, I paid attention to my own advice, I'd probably be further along today, but how kids and families come along and take the steam out of some of that sometimes. But bottom line is that when you look at how to invest money, you have to be somewhat smart about it. You have to work with professionals that really do have your best interests in mind. And here we go with that thing, because what has really been playing a large presence in the whole financial services industry lately is this fiduciary thing, this definition of what a fiduciary is, and we should be, talking to fiduciaries. Well, I've been a licensed financial professional since 1987. Do the math, that's 35 years. What does that mean? Well, licensed by whom? Well, in the financial services industry, you want to be licensed with FINRA, the Financial Industry Regulatory Authority. So you have to have Series 7 licenses and Series 24 principals licenses and Series 6 licenses, and it goes on and on and on. That requires testing, and every 2-3 years you've got to do tests to stay licensed,
continuing education.
continuing ed
Yeah.
and so forth. That's something that's always been going on. And in the last, I'd say, in the last 3 or 4 years, there's been a big move for people to drop their licenses and go to a new platform called a registered investment advisory platform that doesn't require any licensing at all.
None at all?
None at all.
How do they get away with that?
Well, the way that they're getting away with it is because they're licensed with the SEC, Securities and Exchange Commission, but the SEC does not have the rigorous compliance review process with those individuals as FINRA does with licensed financial professionals. So if you want to offer individual stocks, individual bonds, mutual funds, variable annuities that have security investments in it, you have to be a licensed financial professional. You must have the credentials, which automatically make you a fiduciary. Okay, and that just takes hours and hours and hours and hours and days worth of exams and all the things that you've got to take to continue the ed and so forth over the years. And in the world of the RIA platform, all you have to do is get the firm licensed, which is fairly easy. Now, Netvest Financial is a registered investment advisory firm. We opened up the RIA part of the organization for the sole purposes of doing estate planning, which I'll get into in a minute. All of our investment advice is still done on the security side of the industry, where everyone in my office, everyone that's talking to clients is all licensed professionals, licensed in the securities industry. And it's really important to understand that it's that level of expertise that really provides, in my professional opinion, the best for what the client needs to have. Because you see all these things out there today. What should I invest my money into? I mean, you've got, these new platforms that have opened up where you can invest money on your cell phone now. It's kind of funny that they named it Robinhood, but you can even buy fractional shares of something. Yeah. Someone can go in and invest, buy $15 worth of Apple or $15 worth of Amazon. That's never been heard of before. And what you're seeing is a big movement from all the beginners in the world putting zillions of dollars into these applications. And I already know where all that's going to go, but we'll wait and see what really happens, okay? How you want to invest your money needs to be thought through very carefully, and it has to be done with the knowledge and expertise and guidance from a licensed financial professional, in my opinion, because there's so many things to invest in. You start out, what do you think about doing? Well, there's individual stocks, there's individual bonds, because that's really what the whole thing boils down to. Equities and fixed income. You either own the company by purchasing a stock, or you're buying a debt of a company, which is a bond. So they're promising you, like you buy a treasury bond, you're giving your money to the U.S. government in exchange for this term that they're going to pay you interest along the way, and that your principal is guaranteed to come back to you at that stated period of time, the maturity date. Okay, that's fixed income.
I never knew that.
Yeah, and now there are corporations that have fixed income instruments. They're corporate bonds. And then there are a million different variations, okay? So, but the bottom line is that there's equity and fixed income. And in the world of perfect, if there is one in the investment world, is a balance of those two things, okay? It used to be that back 10, 15 years ago, when you went to retire, you would say, okay, well, how much should I have in stocks? How much should I have in bonds? It used to be, well, if you're 60 years old, you take 60, subtract it from 100, that's 40. So you should have 40% in stocks and 60% in bonds. That was considered a pretty safe portfolio. But that's when bonds were doing 10, 12, 14% returns.
Right.
Yeah.
Okay.
What are they now on average?
10% of that. So 1.5 to 4%. So I mean, it's not practical to have 60% of your portfolio in fixed income like that. And what you want to look at is you want to look at dividend producing equities. Okay. So you may see an overweight to stocks, but the overweight to stocks includes a section of that stock allocation to be dividend value stocks that produce those dividends. It's a bond alternative. Right, so that's really the balance that you want to reach out and try to get for yourself, you know, while you're accumulating and when you retire.
So real quick, like if Vince and I, we're looking at finding a financial planner. I mean, what are some of the things that we should be looking for when we find an organization like you? What should we be
So let's
vetting?
start out by redefining the term financial planner. Okay, because I am not a certified financial planner and I don't want to be one. Okay, it's a designation. That is a very good designation, but certified financial planning is about creating a plan for you, selling you a plan, and trying to adhere to that plan and that strategy over time. Okay, that's not necessarily always the best way to approach it. Okay, I've not wanted to do the financial planning because I don't think someone should get charged for a plan. I think a plan should be part of the investment process. So I've never wanted to be a planner. I've always wanted to be a doer.
Yeah.
Okay. So it's a process of working with everyone's assets and understanding what their cash flows are, what their retirement goals are, how much they're getting in Social Security, what their medical expenses are going to be, how much they have, how much is coming in, how much is going out. Okay, and what you're anticipating your desires financially to be. Okay, and hopefully we can make all that meet. And that requires your strategies changing every year because things change every year. A great example is with the whole COVID thing. Everybody's plans changed. People stopped traveling because they couldn't anymore, and now they want to travel, but they can't because they can't even find an airplane anymore. So things have all changed. So what did that do to basic plans? It changed them. So you've got to have active strategic plans in place for you to be able to do the best job for your clients. So when you're looking for someone out there to help you, you've got to understand what their expertise is, you've got to understand what their licensing is, and more importantly, who's regulating every step that they make. Where's the checks and balance systems in place to make sure that the advice that you're getting is right? Because there's so many products. I mean, should I buy a mutual fund? Should I buy an annuity? Should I put my money in CDs? All these things are questions, and the answer is, yeah, probably C, all the above. Okay, so you have to have somebody that has the expertise, or be in a firm that has the expertise to be able to look at all those different products and different services and create the best strategy for the product based upon what fees and expenses there are, and to make sure that they all coincide with one another to bring about the best result.
And what you do, is there any tax strategy that you...
And that's another issue too. Taxes are another one too. It's all about taxes because there's only one way you can avoid taxes.
Die?
No.
Oh no, yeah, you got to pay them.
Because you got to pay that too.
Yeah.
But no, you don't make any money. That's how you avoid it.
Okay.
Well, they always say
It's
that
not a
tax
great option,
now,
right? But yeah, right.
Tax now, tax later, tax never, right?
Well, yeah, and I tell my clients all the time, my goal is to create more taxes for you.
Nice.
So put
They
you in a
just
higher
raised
tax
taxes
bracket,
yesterday.
you know.
Hey, quick question. Going
Yes.
back to what you had, you were saying all these different products and slices.
Sure.
I got an email from Charles Schwab, not
Yeah.
yeah.
Personally?
Yeah,
Okay,
yeah.
Chuck.
Charles Schwab. I got
Okay,
text
yeah.
from, but they sent an email basically saying lend securities.
Which kind of securities?
Lend securities.
Lend securities.
And
I'm
it
not
caught my
familiar
eye
with
for a minute. I got busy and moved on. But I saved it because I want to go back. But it was actually like you can lend your securities to other investors and make interest.
This was done through Schwab?
Yeah.
Wow.
It was like a marketing
Go in.
email. Hey, learn about lending securities. So it might be something brand new.
Sure, it wasn't more about securities that are fixed income securities that are put out by lending institutions? Could be that too.
It sounded like they
Because I've
wanted
never heard
me.
of any value in lending your securities to anybody.
I don't know. I'll forward you the email, but I just thought maybe
Yeah,
it was something
no.
you knew. It kind of caught me off
That
guard.
sounds
Like,
kinda-
okay, this sounds like a new product where you can actually loan. Maybe you're even loaning money through your account to help someone else buy securities. I don't know.
Now you can have collateralized accounts. So if you have securities with a firm, they'll collateralize a certain portion of that account and loan you that money at an low interest rate.
No, it
like
sounded.
a margin account.
I'll look into it further. So it's
Yeah,
a bad question.
love
I
to
thought
look at
maybe
it.
you heard
No,
of it,
no.
but it sounded like they wanted me to lend to other investors
Yes,
for an interest.
that would be weird.
New, right?
Yeah, because I wouldn't see any benefit in doing that. But you never know.
Anyway, well, we'll get to the bottom
yeah,
of it, but I just
yeah.
want to ask.
But there's a lot of things in this industry that we have to be aware of, and it really starts out with being with people that are credible and have a good line. In other words, they've got a very substantial practice, a very substantial history of doing the right thing for people. Again, with licensed financial professionals, with FINRA, you have broker check. So you can pull up any licensed financial professional's name online and see how good they've been or how bad they've been for the last 3 decades. You can see their client complaints. You can see what they've done, how many firms. You got a guy that's been, or a person that has been changing firms every year or every 2 years. I mean, it's like any other, industry. You'd have to question that, okay? So all of that information is out there for people to check because this is your money. You don't, I mean, and I don't know if I should say this, but one of the biggest problems I've ever had is why people ever gave their money to a guy named Madoff. It always bothered me.
Bernie?
Okay. Yeah, or
Good
Bernie.
return on investment.
Yeah. So, I mean, it's that obvious if you just pay attention. This is everything you have, folks. I mean, this is all you have. So you have to be careful of who you're working with. And it's not necessarily the big name companies that give you protection. What I've found out through the years is that the larger the firm, the bigger the name, the more, the bigger the blinders are on the individual that you're working with in the firm. That's why being an independent financial professional, like we are, means that we're self-employed. My firm is my practice, I own it, and I have the ability and have the access to every investment platform in the universe. I'm not being told by corporate that I have to offer this mutual fund platform or this institutional money manager or this series of annuity products. I have the whole world available to me. So myself and my team do the due diligence and look at all the different things that we offer our clients and make sure that those are the things that are working best for what we want to accomplish for our clients. And then they all change too.
But
So you have to be versatile there.
Real world, the problem is for the layman, and I've got
Sure.
a few that work for me, and I'm like, you need to do some planning. It's just, I'll get to it, and it depends on who they meet. So you can meet, someone's more into life insurance or VULs and think,
Sure.
okay, this is a retirement tool. Then maybe you meet someone like you that maybe push more equities, and it becomes confusing. And then this guy's telling.
That's a good point.
And even for someone like me, I don't know sometimes. I'll do some of my own trading. I've got some other investments around.
But see, I've been a 30-year insurance professional as well. So I know what whole life is. I know what universal life is, variable universal life, variable whole life. I know all those products intimately. But one of those products may be the right thing for a person.
Right. No, you're dead on. I'm saying
But it can't be all one thing.
How do you close the gap to Joe, mom and pop, everyday worker? Because the only way they're investing now is 401k. I know because we.
Let's talk about that for a second.
How do you say to them, it's a tool? Oh, I want a 401k. It's great. I don't think it's the best move, but it's the lowest hanging fruit because it's right at work. I sign up easily, take it out of my check. I'm done.
Well, 401ks are great, okay, because systematic investing is the best way to invest your money, inside a retirement plan or not, okay? If you put $10,000 into a portfolio, it's, even though it's very well balanced and so forth, it goes up and it goes down, okay? What's neat about retirement plans and putting money in every 2 weeks is you're using one of the best practices in the money business, and that's dollar cost averaging. So every 2 weeks, that amount, that set amount, is going into that portfolio, and you're hoping that day when it goes in there, that portfolio is down, so you're getting more for the money. And if you look at the averages over a 10, 20, 30-year time, you're going to see that by doing dollar cost averaging, systematic investing, you blow the cover off the ball when it comes to having the best moments of time to invest your money. That's why it's a great thing.
Interesting.
That also, you get a tax deduction, or you're not having to pay taxes on that money when you put it in there.
Down the road, and you don't know what the tax structure is
Well,
going to be.
two things
right?
on retirement plans, and then because it really is more complicated than that, but two things on retirement plans. You've got to know what it's going into. You've got to discuss with someone at some point in time what it's going into, how it's going into, why it's in what you're putting it into. Sometimes it's hard to trust the 1-800, dial the 1-800 representative numbers on the 401k plan. They don't have the training and the expertise to really drill down into what part of the portfolio you should have more money in and what not you shouldn't have more money into. So that takes some expertise at a higher level. But the other thing too is that you don't want all your money in retirement funds. I'll give you a great example. I've known people throughout the years that they've worked for 30 years and they come to us and they've got millions of dollars in their retirement plan and they have not saved anything in non-retirement plans. Well, now
what's the difference? I just interrupt because
Sure.
I don't
go
know.
ahead. Yeah.
So I want the audience to understand that.
Yeah. So if you saved up $1 million in your 401k or your retirement plan over the next 30 years, you got to remember that you've never paid tax on that.
Right.
Okay, so that $1 million is now available for you to use when you retire. Well, when you retire, you're supposed to be in a lower tax bracket. But if your retirement plan is large, when you start taking income from it, it keeps you, with Social Security, keeps you in a higher tax bracket, so the IRS gets more money. Right? So what the goal should be
That's
is
the tax later.
Yeah, right. What you should be doing over time is you should be investing in your retirement plans, but you should have an equal non-retirement plan investment strategy as well. So at the end of the day, you've got a balance of
What does
to
that
be
look
taxed.
like? Where's my money going in a non-retirement plan?
The same place it would in a 401k. You're in mutual fund portfolios. You're in stock and fixed income portfolios. Okay, because you can't get returns at the bank anymore. But it's the same investment strategies that you would use in a 401k, you should be doing in non-qualified accounts as well.
Okay.
So would a company, and I'll use mine as an example, be better suited? We use a PEO that has a good 401k program, and boom, everybody's
stick with
happy.
that,
We
stick
do a
with that.
match, right?
Yep.
But does it make more sense to find someone like you as a company and say, we have one person or one group that's going to handle all of your investments?
People like to lean in their own directions. At least that's what I have found out. 401k plan is pretty commonplace because they're all employees of a company and you're using one plan, so they're kind of all together in that thing, and they don't spend a lot of time of thinking about it, talking about it. What's the money going into? Am I in, what funds am I in this thing, and so forth. So they don't spend a lot of time, nor does the plan people educate them all that well sometimes. No. So that's one thing. But when people come down to investing their money themselves, they're kind of private about it, and they want to have their own direction and their own people to work with at the same time. I mean, you could, there's a lot of times where I've spoken to employee groups to try to get new business and so forth with the non-qualified side of things. And, we already have somebody, or my mother sent me over here, or my brother sent me over there. So you're kind of fighting that. So not necessarily you can do it as a company. It's hard to do it that way.
Well, I feel terrible because we really try to push our people to just do the 401k, do something.
Sure.
Because we match it, it's free money. It's
well, that's got to be, you got to at least do that part.
So we push it, and you still don't get the participation that you think you should have. So I'm wondering if it's more of saying, hey, we've got this investment firm, we would like you guys to go to, if you're not going to do the 401k, get with these people, put together a plan. We're insisting because I think you need to push people.
But if they're not doing the 401k, they're probably not going to do the other either.
Well, the response you get is, "Oh, I heard 401ks are bad," and it's like, so I'm not interested.
Well, let me get this straight now. If I'm going to put 3% of my paycheck in there and your company's going to give me another 3%, what's so bad about that?
I don't know. It's just
That's 3%
amazing
free
to
money,
me that
right?
the disconnect. And I'm guilty. You know, I didn't invest as well as I should have when I
A
was
lot of
younger.
times, though, they can't afford it. That's usually what
Yeah.
it boils down to.
Right.
So that means you need to pay them more. So
Oh.
that's where that goes to.
We can edit that out.
Right.
Is that part of your rules? Well, let me ask you. So, what is your best type of client? Is it someone that comes in and says, "You're smart, do what you need to do," or is it someone that's a real pain in the butt?
Those are the scariest people. When we work with our clients, and our clients range from usually from 45 to 75, that's the age bracket. We want our clients to be educated. There's no one that will just, when someone says, "Here, take all my money," the flags go up. Okay, because they've got to understand what the money's going into. We've got to have, quarterly conversations. We've got to sit down one-on-one. We've got to know what your needs are and how often they're changing and what your expenses are and how much you're going to contribute to the grandkids' education and all these other things. So we've got to understand that. And oh, by the way, are you going to sell that house, and are you looking at another house? Are you looking at a second home? You've got to know all those things in order to give somebody the right advice on how to invest their money. You just do.
Yeah, that's interesting because I know when I looked at opportunities in the past, it would be like, "What do you mean? Why are you asking me all these questions? I want the biggest return you can give me," and it's just not.
But it doesn't work that way.
It's not that simple.
Okay, yeah. That's like I hear these annuity commercials, and the best annuity is one that pays 25%. You can't find one. That's
I
a
just
true
got
statement.
That'd be a good one. That'd be a real good one.
I got offered one at 6% and reviewed it, and it looked pretty good.
Okay.
But then somebody told me, "You're gonna, put $1 million in that. That's your money."
They're not going to give you 6%. Okay, so that's a whole nother story
Right,
that we
no, I
could
get
spend hours and talking on
But
how
even
annuities work.
and I
but-
have time, and I
Yeah,
understand more
yeah.
than the average person, and I'm confused. But when you're saying your age group is 45 and up, I'm worried. Well, because I have kids, I'm worried about the ones that are 20, 25.
right.
What do they do for those 20 years? Because I wasted them by not investing. How do you get?
Well,
to
you
them?
couldn't. You couldn't. I mean, we all tried doing that. I mean, I have 4 kids and 5 grandkids, and I mean, we all tried. We didn't start putting money away until we're in our 40s, 50s, that kind of thing. And it's when our kids got a job and didn't take it from us anymore. So, but bottom line
They're
is,
off the paper.
bottom line is, okay, you got to look at really what you're trying to accomplish, okay, and your age and how much you have to put away and what style of life you really want to live. And that has to be brought into the picture, and that's an ever-changing thing as well.
Yeah.
So you've got to talk about those things with your financial professionals. Now, let's veer away from the financial side of it for a second.
Right.
Because this leads us right into tax planning, okay? Because what good does it do if you have $5 million in an IRA, because all of a sudden now you turn 59 and a half, and $5 million worth of an IRA could give you $200,000 or $250,000 a year and still grow, okay? But it puts you right back in a high tax bracket because all your money's in retirement plans. So that's not necessarily a great strategy to bury all your money in retirement plans. That's why before I was saying you should have half and half, okay? But tax planning is really, really important because it has an effect on everything we do. Now, when you get even older and it starts affecting your Medicare and it starts affecting other parts of your life, taxes can be really, really painful. So having a tax strategy incorporated with your investment strategies and your asset management strategies is really, really important. What we see in the industry right now is that the tax people are over here and the financial people are over there, and you got the bankers over there, and then you've got the you-know-who's over there that
The companies offering 401ks.
well, yeah, but you got the you-know-who's over there that are doing the documents and all that other stuff. It reminds me a lot of going to the doctor, Okay, so you got to go to 4 different places in order
Yeah.
to get anything done. Well, years ago we brought all that talent in house. Okay, so in addition to great asset management from an independent firm, and having tax capabilities, tax planning capabilities, and tax professionals built into that scenario, you also need to have the legal aspect of it taken care of as well. We have to have the legal resources available for us and for our clients to create the proper structure. And here is where we really get into some conversations. Because should I do a trust? Should I have a will? What does it all mean? What about powers of attorney? What happens if I get sick? What happens? The legal documents, okay? There's nothing in the world that says you have to get legal documents from an attorney. Only attorneys tell you that, okay? There are ways of getting access to the legal part of the equation by professionals that know how to do it. So trust planning is really, really a big part of what we do. I've been doing a seminar series for the last 20 some odd years called Trusts and Beyond, and it talks about creating trusts, why you should have a trust, why perhaps maybe you shouldn't have a trust. Because there's a whole bunch of misconceptions on how that works. A lot of people are told, well, trusts save me taxes. Trusts protect my assets. Both are untrue. The only way to reduce your taxes is make less money. A trust is a document, it's a structure.
But
it doesn't make you
protect the asset.
I'm
part.
coming to that one, okay? Trusts do not protect assets in any way, shape, or form. How can that be done? It's a document. It's an entity that you're creating. It's a lot like forming an LLC. The operative word in LLC is limited. Okay, it's limited liability. When you create an LLC, does that mean all of your assets are protected? First of all, protected from what? And 2, are they really protected? Does that prohibit you from being sued by anybody? No. Okay? We're U.S. citizens. Well, to a point. You do something wrong, that wall comes tumbling down. Okay? If you've done something illegal, if you've done something carelessly, that protection doesn't hold up in the world of an LLC. Any attorney will tell you that. The other part of the problem is that, okay, people are like everything else, sold this thing, and they think that they're going to save taxes and they're going to protect their assets from what? Creditors and so forth by doing a trust. And what you really need to understand is that's not true. If you create a trust with your wife, a joint trust, okay, and you've created this entity, the Vince and his wife trust, okay, the VW trust, all right? So you've created this trust, and now when you create that trust, you're going to retitle the house, put it in the name of the trust. You're going to retitle the business, put it in the name of the trust. You're going to take your 401k plans, make the trust the beneficiary of the 401k plans. You're going to make the trust the beneficiary of your retirement plans. You're going to make the trust the beneficiary of your life insurance. You're going to make the trust the beneficiary of everything. You're going to put everything you own into this entity known as a trust. And that trust, because it's a revocable living trust, doesn't protect any of those assets from anything because it's still wide open. It's still you. It's still your Social Security.
But it doesn't drag them all in. So if
Yes,
someone,
it does.
It does. Okay, so then
Sure.
I have a complete misunderstanding
So does a lot of people.
of a trust because my understanding was, okay, you want to put this all in a trust because when I was younger and I would travel, the kids were little, I'd sit there on literally a white piece of paper and say, this account's there, this is that, this
Right.
goes, because they say, why are you doing it? Well, everything would go to your wife. Well, what if her and I get in an accident and we're both gone?
Right.
The
Now
kids have
that's the
nothing.
reason why you should do a trust.
Well, that's
is so
the
you
reason
can lay
I
it off to
did.
the next beneficiary.
Right.
Not
And
your
you-
wife.
And you name a trustee
Right.
other than,
But
that's what
if
we-
your trust document says that those assets roll completely out to your children when you and your wife die, that trust hasn't been protected while you had it, and it's now not protected when your children get it. That trust has to be written in a way that if you and your wife get hit by the bus, the proverbial bus, and you die together, and all the assets that are in the trust, if the trust says that that trust is to stay intact and be operated by a trustee, which could be one of the kids. If the assets stay in that trust, now that trust, because you died, is now irrevocable. The irrevocability of it is what creates creditor protection. Now that's what you want for the kids.
So I
But
have an irrevocable life.
97% of the trusts that we review spill the assets outright to the kids and provide no protection because they're not done right.
Interesting. So I have an irrevocable life trust also, and that was explained to me, you're dead. Life insurance goes into this account, and that's the only way. Then at that point, the kids access it. And
Okay.
it's not
So
living.
ILITs, irrevocable life insurance
Right.
trusts, were created back in the day when the inheritance tax, the unified credit, was $600,000 a piece or less. So if you and your wife have a $2 million estate today, and there's a $600,000 unified credit, you both die, 1.2 is not taxable, the other 800 is. Okay, taxed at 50%. Okay, hold on. Now, back then, you would create a separate irrevocable trust. You'd put life insurance in it. You would fund money into that trust via gifts and by a technique called the use of crummy letters. And you would be giving your child $10,000 and the other child $10,000, so $20,000 would be going into that trust to buy a life insurance policy inside there. So that life insurance policy would be worth $500,000 to pay the tax on the 800
So
that's
very
left.
confusing.
It is. But here's the problem, okay? The unified credit went from $600,000 each to $11 million each. So you don't have any tax.
That's right.
unless you have more than 22 million, and I hope you have that problem.
Yeah, we'll pay the taxes if we have that
So the
problem.
irrevocable life insurance trusts are rather not needed anymore. Okay, so that's the thing; they're not really needed anymore. So
Interesting.
now
okay,
the $11
that
million
makes sense.
unified credit is coming down to $5 million again in 2025 via the sunset provision that's in place. So if you have more than a $10 million estate, you got to start looking at some planning to avoid that estate tax. But I think that the unified credit is going to go back up again. Depends upon who's running the political show.
To me, I mean, even if somebody has a trust set up,
Right.
I mean, is that something you guys can review for them to make
Absolutely,
sure it's set up correctly?
absolutely.
'Cause I
We
think
do that all the
seems like
time.
some low-hanging fruit that a lot of people probably don't know that it's not set up correctly.
If your goal is to just give your assets
I don't know
outright
if
to your
mine is.
children, okay, if your goal is to give your assets outright to your children, you may not need a trust. The real number one reason people do trusts is to avoid probate.
Right. That was going to be my
Because probate
comment.
is stupid.
Yeah.
That was my comment, and I was just talking to someone. We just made a sales call, and on the way back, I said we're coming in here, and we started talking about trust. I said, well, you know, what happens if you've got 4 kids? What happens if you pass away? Who
Right.
gets the house? Well,
Right.
the kids. That's not in writing
Well, it goes to
anymore.
probate first.
And you have someone that you live with that's going to say it's my house. I've been here
But
for
you got
10
that whole
years."
fight regardless. yeah.
Right.
But, okay, I want you to think about something. So if you do a trust, that's the direction you're going, and you put your house, you retitle the house in the name of the trust. That house, when you die, would avoid probate because it's not in your name, it's in the trust's name, and the trust doesn't die. So it goes to the people that you've stipulated in the trust, okay? But if you don't do a trust, you know how you accomplish the avoidance of probate? You simply do a beneficiary deed on the house that says when I die, it goes to Billy and Bobby and Judy and Barry.
Arizona does that with
$100.
autos very easy. Yeah.
$100 you can do
Easy.
that. Okay? Who's going to tell you that? Nobody.
Nobody.
Because they can't make more than a $20 bill on it.
Nobody. And I was, my father would do a will up in Long
Yeah,
Island.
yeah.
And every 6 months, if he get mad at me, I'm off.
Right.
I get a letter in the mail. I'm off.
Yeah. You're off.
And
Well, keep
your sister now. It's
I've been
not
saying
yours,
this for
I'm mad at her.
I've been
It's
saying this for
hysterical.
decades. A will means you will go to probate. Period.
Right.
I like that.
See, I was asked that just today. Well, doesn't the will cover all that?
No.
I think
Does not.
so, but I
Does
don't
not.
even know.
Because a will says you put together this document. You're single. No marriage. That's another complexity.
I am?
But no. But if you were single and you wrote this, you wrote it on a bar napkin. You said, okay, all my assets go to my 4 children. Blah blah blah. That's a will. It's legal. Okay, or you do a formal one that says that. So okay, you pass away. Well, the house that's titled in your name, how does it get to them?
Right.
How does the bank account? Are they just going to allow the kids come in and grab all the money out of the bank? No.
Don't the banks absorb a ton of money if
No,
some
no.
80-year-old passes, 80-year-old person passes away, has $5,000 in the
No,
bank?
it goes to the state.
Goes what?
State. Goes to the state.
The state.
Yes.
Interesting.
Yeah.
I didn't know that.
So,
What does the state do with it?
I can't comment on that. So, you know what it's going to do. Anyways.
Wow.
But what you have to do is the kids have to hire some of those nice people to represent them with a bunch of their cohorts in this big room that takes them 6 months, and I have actually seen 22 years of probate.
Wow.
For all those people to figure out what you really meant when you wrote that, and were you sane when you wrote it, and once all that's done and all those expenses are paid, then those 4 kids get that stuff.
So
And everybody's mad in the meantime.
I've walked through
It's a disaster.
your facility, and I think one of the most shocking things is, and you could come up with a couple, but pictures on the wall, and you have Rocky here, of like Ted Williams, people that planned nothing and lost everything. Give me 2 or 3 the most famous people that nobody would think died and lost everything.
I've got so many on the walls I can't even remember them half the time. But all the people with the most money, okay, had the biggest groups of law firms that set them up for this to happen, and they never did trusts, and they never did the right structure for them, so they can process it when the time came. Okay. Yeah, you look at what's his name? I used to call him the proxy Godfather, the guy that died because he did the Godfather series.
James Caan?
No, the other one.
Marlon Brando.
Not him. There's another one. Gandolfini. Jim Gandolfini.
James
Gandolfini. Died at 55. Okay.
He was born.
He left behind a $70 million estate. Had wills done.
Yeah.
Kids only saw 35.
Where'd
Joan
the-
Rivers, $115 million estate. Had all the wills in place, all the attorneys working with them. Half of that went to her kids. The other half goes to attorneys' expenses, court costs, and taxes. So this has been going on for hundreds of years.
I used a law firm here locally.
Yeah.
And I thought, okay, they know what they're doing. I've since talked to different folks, and then certainly listening to you today to say, I don't even know.
See,
I don't even know if I'm set up properly. I think
when
I
we
am.
create a structure for someone, we have the access to the right resources that if you're going to create an entity known as a trust, and it's a big book, okay? But if you're going to create an entity, instead of having all 4 of your children's names in the body of the document, you want to put C Schedule B. So back here, you can have the 4 people's names on the B schedule, so you can change the 1 page. You don't have to amend the whole document.
Oh.
Successor trustees, same way. You want a document that is functional for you and your family. You don't want it written so hard and so rigid that you have to go back to the law firm every time you want to make some changes.
When I moved from Florida, came here, went to a new law firm, they said,
Right.
sure, rip it up. do
And
this
your
one.
document should work in all 50 states.
Yeah. So does any company you know, do a great job in all states? Is there any national?
Yes, we do.
Do you know of anybody reputable locally that
Yes,
you'd
we do.
recommend?
On that
Yes, we
note,
do. Very good.
how can people get a hold of you? Like, you obviously don't take everybody, but how can they set an appointment with your firm?
They can call us at 1-833-NET-VEST. That's N-E-T as in Tom, V as in Victor, E-S-T. They can certainly email us at info@netvestllc.com. Those are the best 2 ways of getting a hold of us.
Yeah, well, I'll tell you, after talking to you, man, I think they have a review if they have a trust.
Definitely.
They should definitely sit
And
down.
assets.
And yeah,
Because it's about building the assets and keeping the assets and the control of those assets in your family. Not these outside parties, not us, not attorneys, not CPAs, but where you guys are trained and you have the expertise in your hand. If you've got the expertise to accumulate assets, you've certainly got the expertise to be able to control the structure, period, okay?
They're not cheap though.
Well, what's cheap?
If I'm starting out and I'm a young family and I want to go get a trust and I got to spend thousands, it's going to be one of those.
But if you're a young family and you don't have that much in assets, you don't need a trust yet.
Interesting.
That's a great question.
Good point.
Where's the crossover?
The crossover is really after analyzing the family structure, the dynamics of the family. If you've got multiple, if you've got children from different marriages, that's going to drive the need for a trust for it to be more compartmentalized and so forth. So you have to really design that with words. The real issue is the assets. Okay, if you don't have $1 zillion worth of assets, you don't necessarily need a trust right now, because we can retitle the house in a beneficiary deed. You can actually go to any bank, and if Bob and Jane Smith have a joint checking account, that checking account should be Bob and Jane Smith payable upon death to their children. Right. So that avoids probate. So if you retitle or add the POD registration to your bank accounts, to your automobiles, to your house, you can avoid the probate process real quick. IRAs avoid probate because there's a beneficiary designation. Okay, 401k is the same way. All right, life insurance, same way. Those don't go to probate because there's beneficiary designations. So you can avoid the probate process at a lot less expense than doing trust and estate planning in the interim. And later on, maybe you do.
Great advice. So you're saying like a young couple maybe that owns a home, maybe they own one of their cars and they're paying on another.
Yeah.
If they don't have a lot of assets, they can.
Why spend the money for a trust? You don't need to yet. You don't really need to. The bigger issue is that you really need powers of attorney over health and powers of attorney over assets, whether you have a trust or not, because that's more complex. And that's not that expensive to get POAs.
My wife is my power of attorney.
Right.
And then we have like where our kids go if something happens to us and all that kind of stuff spelled out. But
Yeah.
yeah.
Because they're young.
What, a trust or a will?
Ours is a will. So now I apparently.
Yeah. Well, no, but you can work with that. You've named caretakers for the kids because the kids are young, right? Yeah. Yeah. So you got your sister or brother or somebody that's going to take care of them. So, yeah. So you want to stipulate all those things, okay? And then once you get the basics done, then you work on building the estate. How do I invest my money and make this bigger? And life insurance comes into play, okay? Especially for younger adults that have children and families. Something happens to the major breadwinner. You need life insurance in there, okay? The most uninsured person on the planet is the woman.
Right.
Because especially if she's an at-home mom.
Right.
Do you know what it costs to replace that woman? Millions.
Yeah.
Millions.
Totally.
It's funny you say that. That's right. I mean, when I got my life insurance, it was, okay, what if something happens to you?
Right.
Holy shit.
Yeah.
They're in trouble.
Yeah.
What if something happens to your wife? Do you lose any income? And it was
Because you're going to be doing what she was doing.
Well, I know, but real world, that moment was like, what if something happens to her? What do you lose? It's like, I said nothing. And it came back as no. You child care, the things that are done at home, you actually have to plan for that. You wouldn't even, you just think she doesn't work, stays home, takes care of the kids.
It cost you several $100,000 to have an at-home. Yeah. Yeah.
Yeah,
I think actually
don't even think about it.
Ours was the same number for our wife when we came up with it because they asked those types of questions.
Yeah.
I was young.
I wouldn't even think about it.
No, I was 25 at the time. I mean, I didn't even.
Jerry didn't know. He didn't
No,
know about it.
and it was cheap. I'm like, yeah, give me some of that.
Yeah, and that's the thing. At 25 years old, $1 million worth of life insurance isn't that much money. No. Now,
Sounds good.
that's when you
Not
don't want to
today.
go to a life insurance agent and buy whole life, though. You know the definition of whole life, and I shouldn't say it on a podcast, but the definition of whole life is that the agent gets paid for their whole life.
Awesome. Well, John, this is awesome. I'd love to
can
have
go
you
on
back.
for more.
I'd love to have you back. This is great. I mean, a lot of nuggets that I think anybody can apply. Again, connect with John, in his firm. Go to their website, check them out.
The website is www.netvestllc.com.
info@netvest.
That's the email.
right. At 823 NETVEST.
Perfect. You got anything before we close?
No, I enjoyed it. I mean, I think I have my shit together, and I may not, and that's scary. At the same time, I always think about the youngins coming up, or 30-somethings, whatever, that they don't have a plan, and it's scary. So no. Really
I also have another website, trustsandbeyond.com. So it's trusts, plural, A-N-D, beyond.com. That's the whole trust educational.
You had a commercial running too. I saw you on a local.
There's some
TV
new ones
commercial.
coming out as well. So.
Well, good for you.
Yeah, look for the commercials.
Yeah.
And at this point in your life, you do enjoy educating people, and that's why I thought this would work.
I can go on. So,
Well, thank
you
you
for
so much.
inviting me.
Absolutely.
And look forward to it. Thank you.
You guys, well, thanks for tuning in. I know you got great value out of this, so make sure to leave a comment for John, subscribe to the channel for more episodes coming up, and we will see you next time.
John Cartolano is a financial advisor offering securities and advisory services through Cetera Advisor Networks LLC, member FINRA, SIPC, a broker-dealer, and registered investment advisor. Cetera is under separate ownership from any other named entity. Additional advisory services are offered through Netvest Financial LLC. Cetera is under separate ownership from any other named entity. Branch location is 9059 East Bahia Drive, Scottsdale, Arizona, 85260, and the phone number is 602-230-8222. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Past performance is not an indication or guarantee of future results, and dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income, and if taken prior to reaching age 59.5, may be subject to an additional 10% IRS tax penalty. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Neither Cetera Advisor Networks LLC nor any of its representatives may give legal or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The use of trusts involves a complex web of tax rules and regulations. You should consider the counsel of an experienced estate planning professional before implementing such strategies.